Logan, welcome back to the podcast. We have so much to talk about.
Yes, it's been another crazy week. And again, this is why we created the HousingWire weekly tracker, just to try to make sense of all the madness that happens in post-2020. It's weekly now, not monthly.
It really is. So we're recording this on Friday, March 3rd. And I think the biggest story this week has been mortgage rates. I mean, they went up. Sadly, for our industry, they went up. So let's talk about that. Let's talk about why they are as high as they are and why they won't, in your opinion, they're not going to go higher, which fingers crossed, let's not go any higher. So let's start with that.
So the article I wrote recently talks about, the difference between 1970s inflation and what we're dealing with right now. And I think there's so much confusion out there because the Fed talks a lot on their weekly stuff. And when they talk, they remind me of a quarterback. That's kind of soft. It's always protected by really good linemen. And then when they get a pass rush, they fall to the ground. They can't stay in the pocket. And they have a message that was clear. At least to me, it was clear early on. They want the Fed funds rate to get to 5 or 5.25%, wherever they finally end, and just stick it right there and just wait for the data to get better. And when we have better economic data, you have professional troll people on the internet. It's, oh God, the Fed has to keep on rising rates. We have to go back. We don't want to make the 1970s mistake. That's the whole premise is we don't want entrenched inflation. Except this is not the 1970s. And that article I wrote, there's a lot of details on trying to get people versed with what happened in the 70s with housing to what we are right now. And it also explains why mortgage rates aren't higher. If we're talking about 1970s inflation, 8, 10, 12, 13% mortgage rates, much different backdrop. And if the Fed just stuck to their original plan and not get out of line, then the confusion will be less. And to me, mortgage rates in the 10-year look about right. Economic data got better. It wasn't just the jobs report in January. Consumption is still going through. Service sector inflation data picked up a little bit. So where we are right now looks correct to me, but people get confused when the Fed comes on and says, well, we might have to go to 6% Fed funds rate. Just not the case.
Oh gosh, we certainly hope so. So let's talk about that a little bit. So in your forecast, you had forecast a range for the 10-year yield, which correlates to a range for mortgage rates. Where are we in that range right now?
As of right now, we're I think 3.97 on the 10-year yield. If the economy stayed firm, 3.21 to 4.25, we stay in that range. We go back and forth. The economic data got better. We couldn't break that line in the sand, the Gandalf line. We tried 3 times. And now we're going back higher. Data got better. Consumption is still there. Growth is still there. Manufacturing data, service manufacturing are picking up. So we're staying in that range, which I understand some people thought mortgage rates or bond yields would just straight go down because there's some inflationary or there's some recessionary data. This is all true. I mean, even my old 6 recession red flags were up as of August 5th. But until the labor market breaks, credit deteriorates, and consumption falls, you don't have a recession. It's never worked that way post-World War II. So right now, we're just in that range and we're sticking in there. But over time, right, my thing is think 12 months out. Over time, some of the biggest drivers of inflation slowly come down. And the core PCE data looks a lot different now than it did, back in 1975. So I think everything looks normal if you believe in what the Fed wants. But the Fed talks about entrenched inflation in the 1970s. We just don't really even have that kind of housing market like we did in the 70s, where existing home sales are booming and then rent inflation takes off. And I think one thing that I really tried to get across with that article is that we had the recession in 1974. And in 1974, rates went up and inflation went up. Multifamily construction was going solid there, and then it collapsed in the 1970s, right? We didn't get much growth. Much different story right now. So the growth rate of inflation on rents are falling currently. The CPI data lags like everything else. Then we have major supply coming on to the market. And then we have the Fed on top of that, making the net interest cost of households a little bit more, credit cards, those kind of things, auto loans. So all those things together where we are, it hopefully explains why mortgage rates aren't back to the 1970s, nor does the bond market ever believe that we were in the 1970s kind of entrenched inflation. Because if it did, if growth and wages and everything were about to take off, the 10-year yield would be north of 5.25%. And never been the case right now.
So what is your range for mortgage rates to go? You talked about your 10-year range. What's your range for mortgage rates in your forecast? And do you think we're going to get above it?
7.25% to 5.75%, assuming the spreads are already wide, which they are. If the spreads get better, it's a different story, beneficial for rates, not there, but that range is still stuck. And as of this second right now, it's 6.97%. I think we got to 7.10 yesterday. So everything kind of looks in line. I think where I would have been wrong this year is if the 10-year yield broke underneath 3.21% and the labor market was still solid and mortgage rates went lower. That is the bond market getting ahead of the Fed, believing that the economy was about to break. When jobless claims break, the bond market will get ahead. But I think the confusion this week is, Waller, maybe we need to raise rates again. Maybe we need to raise the target or anything. The growth rate of inflation has already peaked, right? To get a re-acceleration from these levels, you need a lot of other things to go against you. And that's kind of the history of, inflationary periods. You see that top end levels. And after some time, the things that drive this the most are slowly falling down. It just takes a little bit of time. That's why I say think 12 months out, and things will be much different at that time. And at that time, again, if the economy is still firm and the growth rate of inflation is falling, remember, wage growth, the Fed really believes that people making more money, bad. Wage growth, way too bad, right? So it becomes entrenched inflation, except wage growth is already cooling down already, right? So be mindful. We have a lot of noise. Think big picture. Think the bond market was always right. They never bought into the 70s inflation. So we're just working through the post-pandemic settlement of all these inflationary issues that is part of the history of global pandemics going back 800 years, nothing too deviant on that. And rent inflation is the big driver. That should slowly come down, right? The growth rate was so high, could not be kept at. You cannot get 15 to 20% rent increases year after year after year. It can't sustain itself, right? That was the whole premise on CNBC last September.
So I appreciate the whole look out 12 months and this is what's going. But we are in March. It is March 3rd. We are heading into the spring home buying season. So terrible timing, in my opinion, for the housing market, for those in real estate and mortgage, because the last thing we need are rates in the 7%. Like that is going to just stall out this housing, what we should see in the spring home buying season.
Well, we saw what happened when we went from 7.37 to 5.99. We saw a bounce for about 12 weeks, and then that all went away very fast. And again, for me, the housing market is not designed to have rates go up and down like crazy, especially with the spreads being wide. So we're seeing people just pull back from either listing homes or wanting to buy. And we've had this happen before where rates rise, housing demand slows. We saw that in 2013-14. We saw that in 2018-19. So nothing is too different right about now, but this one is the mother of all rate increases, and it's just not finding any kind of stability. But with all the data that we have recently, and that the economic data got better, some of the inflationary data got stronger, mortgage rates, this is kind of where it should be. The spreads are really wide. That's the thing. And until we're more settled with lower rates or bond yields going lower with inflation going lower, which we don't want to see. We don't want to see bond yields going lower because jobless claims are rising. We need to get out of that mentality that job loss recession is the only thing here that could save housing. We want to have people always working. We don't want recessions. But if the growth rate of inflation is falling and wage growth is cooling down over time, it should get better. But this is the world we live in. They don't care about your feelings or anything like that. Inflation took off, wage growth took off, things are slowing, and we're dealing with the the timing of this is not the best, but again, nothing looks abnormal to me with the data that we have currently. I guess if you were a Fed pivot person and thought the recession started last January 2022, then all this data doesn't make sense to you. But I'm trying to guide people to what data lines are creating this. And, we tried to break underneath a key level. It didn't break, and it was correct, right? Labor market's still okay. Retail consumption is still okay. Some of the manufacturing data is picking up again. In that context, it looks right.
So, we're doing this on Friday. Every weekend, you get the Altos data. So, Altos Research has, really the best data for what's happening in housing, especially for inventory, right, across the country.
It's not fair giving me that kind of data.
I know.
It's just not fair.
You're like a
It's
kid
just
in a
like
candy store with this
like
data.
like I wake up Saturday morning and I know people are waiting for me to tease out what's happening with inventory, and I'm the only one that can do it. So it's just not fair. Nobody should have that much power.
So what do you expect? So we're hoping, we've seen inventory drop lower for the last couple of weeks, and we're like, when are we going to see the bottom? When do people start listing their houses for the spring home buying season? Are we going to see it this week?
So usually we start to get closer to the zero line before we see the increase. So it would actually have to be a noticeable increase week to week. So I think there might be 1 or 2 more weeks, but we're getting toward that bottom. And just for some historical preference, seasonal bottoms in March and April are extremely rare. Like it never happens that way on the weekly data. It's only happened post 2020, and we have some odd phenomenons, late cycle or late seasonal demand increases that are pushing this out a little bit higher. The question for me now is, with rates moving up as much as it did, does it have the similar impact with new listings data? Because new listings data the last week was like all-time lows for that week. Right. So it's like, can we get any worse than this? And that's the thing I'm keeping an eye on, because we saw what happened when mortgage rates got above 6%. Not a good thing for the new listings data. So now that we're above 7% again, does that impact people's thing? Because think of this as if you're a seller of a home and you're looking to buy another house, and you're thinking 6%. Okay, now it's 7%. Oh, maybe I don't, what happens? What if I list my house, somebody buys it and it's 8%? You're just not comfortable in this environment. And this is why, when the spreads were wide, like the Federal Reserve didn't like the spreads were like 1.80%. And that's when they thought, oh, we can't have that happen. It's like 2.75, 3%. This is like historic on how wide the spreads are right now. And their thinking is that the reason they got in the market so much is that they didn't want so much volatility. Now they're like, we don't care. Okay, so this is the byproduct of it. People stop doing what they normally doing because they're not comfortable. And you don't ever get to see this historically unless you have mortgage rates rise from 3 to 7%. But you could see these really sharp increases impacting the data.
Because mortgage rates are now above 7%, or at least have been, in the very short term, what do you think the stabilization point is now? So, for instance, say we saw 5.99. Really, we saw people interested there. The problem is it just didn't have duration. So, what would be the point, the inflection point with duration that would draw more people to list their homes?
So I want to remind people, last year when rates started to fall from 7.37% toward 5.9%, the internal data got better. So that's one thing that we have to if rates just come down 0.25% to 0.5%, does it have the similar impact? For me, you get to the fives, the low fives, and you stay there. Around there, you can create a base to work from. What occurred is that we didn't even need 5%, 5.99%. Now, of course, rates are being pushed down by, seller concessions, and builders are paying down. So the headline rate is actually lower than what the final lock rate is. But, getting some stabilization at 6% is a big deal, right? So again, the 10-year yield, 3.5, 3.42, around there's where you actually had some stabilization. We're finally seeing it in the sales data. It just happened in November and December. It just filters itself 30 to 90 days later. So again, now you see the hit to demand. It'll happen in the sales data a little bit later. So we're trying to get the weekly data to make sense to people. And it's just so wild, right? And then people get confused when the Fed says, well, maybe we need to raise rates more. Just stick to the original plan and endure. You're going to have to be tough at some point. You can't move around because everyone's going, what's wrong? Stick to the original plan. What the Fed doesn't want to do is raise rates so much that they have to cut rates faster, right? Because it doesn't matter if the labor market breaks, the bond market is going to get ahead of them, and then people are going to say, "What's the Federal Reserve again? Old and slow, right?" So you want to lose that stigma, but you're going to have to stick to the original plan and endure, right? And that means if data sometimes gets weaker, you don't need to cut right away. Let the labor market, let your dual mandate come in place at that time. But man, one strong data line here and there, everyone's like, oh, we 6%, 7% Fed funds and stuff. The yield curve is so inverted. It's stick to the original plan, endure, give it time, let what happens after every global pandemic, the growth rate of inflation falls. And then hopefully that article that I wrote on Friday, some of you can understand what I'm talking about. For me, it's not the final answer that matters. It's the why. Once people understand the why, then they can see, all the screaming heads out there, things might not be as they have talked about.
Hi, this is Diego Sanchez, COO of HW Media, and I'm joined today by Alex Ilazai, Chief Strategy Officer at United Wholesale Mortgage. Thanks for joining us today, Alex.
Hey, Diego. Thanks for having me. Good to be here.
So diving right in, we might be seeing the first glimmers of a rebound in the housing market. How is this playing out in the broker channel?
It's playing out really well, so we're excited about 2023. We see a lot of optimism in the market, just like we in 2022 and leading into Q4, and we're hitting the ground running really fast in 2023 here in Q1. We're excited about this whole year and what's upcoming. We've launched a lot of new products. We continue to see a lot of optimism in the broker channel overall. And obviously, when we're in a purchase market as we're in right now, that's where brokers really thrive in the more complex transactions with buyers and sellers and agents and a lot more going on. Just brokers are the best place for consumer to get a loan. So we see a lot of them continue to grow and thrive.
Digging in a little more there, most forecasters are seeing rates in the 5s and the 6s for 2023 and 2024, which means we will be in a purchase market for the foreseeable future. Is this good for the broker channel?
Yeah, it's great for the broker channel. Like I just mentioned, just assume a rate's at 6%, right? We have temporary buy down products, just as an example, where you can buy down that product where the first year you're going to pay 4%, second year you're going to pay 5%, third year and beyond you'll pay the 6%. And by that time, hopefully we'll be in a position where you can refi that loan. So really, there's just so much opportunity. To me, the way that we think about it, Diego, is like you're dating the rate, but you're marrying the house, right? So you want to go out there, if you see the house that you like, you see the property you like, you buy it, right? And you worry about getting that lower rate maybe in a back half of the year or even next year. But again, it's just going to be a short-term thing the way that we think about it. And still, relatively speaking, we're not talking about massive interest rates, right? I mean, the days of the 2s and the 3s that we were experiencing in 2021, that was somewhat of an anomaly. So we expect them to come down a little bit, and all the forecasters and economic indicators are pointing that fashion. But right now, I think we're in a good spot, and brokers are continuing to win. And you can see it in our broker share and everything that we're doing. We're just having an outstanding start to the year. Yeah, I mean,
the broker channel's had a great couple of years of growth. Do you expect that growth to continue in 23?
Yeah, we do. I mean, as you mentioned, in the third quarter, which was the latest quarter, actually fourth quarter, is about 22.5% or so of the market is broker now, which is, I think, at the highest since 2009. So we're continuing to see great trends in the overall growth of the channel, and we expect it to be 33% by 2025-26. Like that's what we're expecting to see the numbers come in at. And a lot of that is being driven by just literally hundreds of retail loan officers that are leaving retail and joining wholesale every single month. So those numbers are continuing to do great. And we're actually seeing, as another example, Diego, at UWM here, we have about 400 to 500 loan officers that come in every single week for Success Track, which is a great opportunity for them to learn, develop, network, and help grow the overall broker channel together. So you're seeing a couple thousand people a month that are coming in, and that was happening in all of last year, right? And all the years, several years before that when we started. But if you think about like the times that we're in, right? Everybody talks about a lot of the negativity, and that's what the usual focus of. But the reality is, people are excited about it. Brokers are excited about it. The market's growing. And at UWM, obviously being 100% wholesale, no other company in the mortgage space is better positioned than we are.
I love seeing the confidence and the leaning in that's happening at UWM. Alex, thanks so much for joining us today and sharing your insights.
Great. Thank you. It's good to spend time with you.
So the jobs report, the end of month jobs report got pushed to next week or this week by the time this comes out because of, the fact that February is a short month. But, we're looking to that because that's a huge data line for the Fed to decide what they're going to do. What do you think it's going to be? You think we're going to see anything big?
I want to remind everyone, if there was no COVID-19, right, we had over 152 million people working. And if we just took the trend job growth of 2020, we'd be about 159 million right now. If I reduce that trend growth 2020 to 150,000 jobs, we're about almost to 158 million. Okay, so the civilian labor force is 166 million. We have enough labor to get back to pre-COVID trends, so we're in makeup demand. I find it a little interesting that the Fed says on one point, we don't have enough labor, and they have these big job reports.
For those who can't see you, you're making a hilarious face right there.
Yeah. Okay. So I'm just like, okay, so the civilian labor force is enough to get labor back. So if you see a big jobs print, that means people were there. Until we get back to that pre-COVID trend. And the closer we get back to that, I think job growth slows down more and more, but we're still in makeup mode, right? And I really had to explain this on Twitter. I just don't think people are nerdy enough to look at all the data. So think of these big job reports and then think of what was the Fed trying to say? There's not enough people working. Well, why do your job reports are still big? Okay, because the civilian labor force is still about 166 million and 158 to 159. The closer we get to those, then you start to see the job growth kind of slow down. But wage growth is already slowing down. Job openings data, some of the other internal job openings data is already slowing down. You don't need to create a job loss recession to break inflation. This is not the 1970s. We're dealing with different stuff now. And that's my whole theme, is that you're going to have to endure and make up jobs. Remember, look, I'm the guy that said JOLTS 10 million, job openings 10 million early on, right? But you have to give it time because it looks really suspicious now when you're talking about for 12 months, we don't have enough labor. And then wage growth is cooling and we still have big job numbers. Something went wrong with the Federal Reserve's mindset on that, right? Because then this means that you don't really need to create a job loss recession together. I know that some of the Feds will say, listen, the history of fighting inflation is a job loss, but you could just endure at these levels and let time work itself out. Unless we have another supply shock, another war incident or something like that, time is your best asset here, and you could keep your dual mandate intact by doing that. So, and the bond market is already telling you it's not 1970s. If it did, mortgage rates would be higher. The 10-year yield would be higher than what it is, right? And those charts, right? Those are specific inflation 10-year charts and mortgage rate charts that I put in there in the 1970s. It's not happening, and we're already well into this. So it's a really good time in history to really look at people's models and how they look at things, because you only get tested when you have such a crazy event like a global pandemic.
Okay, so I asked you what you think jobs are going to do, and I don't know that I got a straight answer from you.
Jobs should be continuing. I think we're not going to have another 500,000 jobs print. I think there's some seasonality issues with that, but still, job growth is healthy. Again, we're still far from 158 million. That's kind of how my mindset is working. Until we get to like 158 to 159 million, you still have enough labor to get back to there. So it's just taking a little bit more. I understand why some people are confused. The Fed says we have to raise rates because the 70-year-olds aren't coming back to work. Part-time 70-year-olds, that was what you're counting on? Jeez, but we do have enough labor. I think that's the one benefit of the United States of America. We do have a lot of young people. We don't have some of the structural issues that Japan or China or Europe have. So just give it time, because I understand it looks really bad to say for 12 months. Nobody wants to work. Inflation might take off. Wages might go out of hand and then all of a sudden, wow, these job numbers are really big. What's up with that? Come on now. Wait, you got to pick a side, right? Endure. Don't act like a soft quarterback. Some of these might hit me. They're rushing the QB. I can't let my face get hit. Dive to the ground. Come on. You had a good game plan. Stick with it.
That's what we need. I mean, when you said, that rates could go up 8, 10, 12, I'm like, oh my gosh, don't even say that. Bite your tongue, Logan Mohtashami.
No, I'm saying that if we did have the 1970s inflation, we would have already been there. Right. That's my whole thing. My whole thing is that if the 10-year yield doesn't break above 5.25% early on, the bond market doesn't believe in the 70s inflation, and it did it, right? We had the dollar get stronger last year, and we had some foreign selling of treasuries, stuff like that. But I mean, still today, if I'm blind, then I'm just looking at all the inflationary data, and it looks like it has peaked. And some of the biggest factors that are holding it up, this are actually going to look lower. So give it time. That's why October to October, right? 12 months, things should look better. But you can't freak out. Oh my God, retail sales beat. Kill the economy. Kill the economy. What? Come on. This is why I really do believe that your elective officials, or they can't freak out like this every time. Growth is not a bad thing. People making more money is not a bad thing, right? And it's just it is confusing for people who are told that there's nobody wants to work, and we have to destroy the economy because nobody wants to work. And guess what? We have these big job numbers, so something is wrong there, right? Think about it in that light. Give it time. Let us get back to the pre-COVID job trends. We'll get to 158, and then things get back to normal. And what is normal? Population growth is slowing. Inflationary data should go back to trend in an older society. If there's supply shocks, that's a different story. But we didn't change the entire world's economics out of been like that. It was a global pandemic. It was a war. These things disrupt a lot of issues. Bird flu. Look at egg prices. Egg prices spiked up. Oh, the Fed's got to raise rates. No. The Fed can't control bird flu. Come on, people.
I don't have any of those problems because I live in a semi-rural area, so I get free eggs. So I've been left out of the whole egg inflation story, thankfully.
Lucky you, Sarah Wheeler.
You sitting there in Irvine, California. There's no chickens around you, are there? You don't hear chickens.
Hey, listen. We got a lot of chickens in America, right?
Okay, I'll give you that. Okay, so for the remaining time, you and I need to fight about the mortgage rate lockdown because listen, since you said that, I feel like you make my point several times during this podcast.
I feel like you think you're making your point, but you're not.
Because you're like, well, if rates can just get back down here, then people will feel like they can list their homes. And that is, to me, the essence.
So that means that there wasn't a mortgage rate lockdown. They couldn't afford the house, right? You just made, see, all of you people make my point for me. You don't even know it. Mortgage rates falling make housing affordable. The mortgage rate lockdown premise was that nobody will ever move because their rate is so low, right? And that's the primary factor, except from 2011 to 2020, right before COVID, we had a 3.25% 5% range. So we've had people who had 3.25% or 3.5% mortgage rates buy a house at 4.25%, 4.5% because they needed a bigger home, right? So we've had people move and sell with the rate deviation always. It's just that now people don't see. I'm not saying that people are going to rush to the market and sell. I'm not one of those crazy people on Twitter. And by the way, some of you Twitter trolls out there, dear Lord, it's like,
I have to agree with you on that.
I'm telling you, it's like housing has to explode. And every realtor and mortgage person has to lose their jobs for these people to feel good. And you know who I'm talking about because I know you're listening. How bad is your life? Seriously, like 10 years, I've got to hear this. Like, how bad is it? Has to be, Don't
change the subject, okay? I do.
No, I won't. But going back to what you said, mortgage rates falling up and down, inventory has been slowly falling for years. So the mortgage rate lockdown premise came back when 2018. People said 5% rates, nobody will ever move again. Rates fell down, Inventory didn't move around anywhere, didn't have any growth, right? People move for a reason, right? And affordability is more of an issue here because the total PITI costs, principal, interest, taxes, and insurance, had a massive increase, right? If we didn't have that massive increase, if we grew in that, price growth model, things would look normal. It's just now homeowners are in really good shape anyway. Before COVID, they even got in better shape in COVID, but they weren't moving as much. That's why I don't want the mortgage rate lockdown, because it's unsophisticated. It's a one variable topic. It doesn't take, here's a good idea. Why don't we say home price lockdown, HOA lockdown, property tax lockdown, loan balance size lockdown, which is the biggest driver of what the actual principal interest. Why don't we use those terms, right? We like the word mortgage rate lockdown because it's simple. It's a simple marketing tactic for people, but the total principal interest cost matters, right? And that explains 2012, 13, 14, 15, 16, 17, 18, 19, 20, and 21, 22, 23. People have been living in their homes longer and longer, and when they need to move, they will move if they can afford to buy a house. But don't tell me that I'm not moving because I don't want to give up my 3%. Can you qualify for a house at 7%? No.
So yes, there will be people who couldn't qualify, but from my perspective, the difference between 3 and 7% is so big that this is a new variable. So yes, in the past we've seen, they moved down, this much, nothing happened. We're talking a gigantic difference.
Sarah, there are people listing their homes this week and selling them and buying another house. So why doesn't the mortgage rate lockdown work for them?
Because they are compelled, and they're going to take
what? They're going to take what?
Take a hit on
take a hit on what? They can afford the house. Nobody's taking a hit. If you can afford to buy, you buy. It's a total principal. It's a total PITI cost, right? The mortgage rate variable is just one of many things that go into the entire equation. We use it as a marketing tactic, but it doesn't explain what happened in the last 8 years before COVID. Right? When rates were at 3.25 and moved to 5, people moved. People said that would never happen. Home sales were much higher back then too.
But
people move every year. It's just that the historical changes of post 2010. Like, here's a good example. Why did inventory increase from 2000 to 2005? When the sales boom, massive sales boom, rates were higher, right? Why did people move? Because the credit channels were different. Credit were facilitating people to move because rates didn't matter. You could just, that's why inventory grew with sales. Now it's different. You have a 30-year fix. So that total PITI cost really matters because you have to qualify for it. And some people say, well, I really like my life. I'm comfortable. Well, if you had to move, Sarah Wheeler, if you had to move, guess what? The rate doesn't matter to you. You will sell that property and move. Isn't that right, Sarah Wheeler?
It's right, except that here's what you're leaving out, Logan Mohtashami, and that is because what we want is a healthy, balanced market where the only people moving, the only people listing their house aren't those who are forced or compelled by other reasons, but who just might want to. That would be better for the housing market.
This has been here for 10 years. And even before rates came down to 3%, again, because we were here before. We were at 3.25 before in the previous expand. And people still moved because the total PITI cost made a move. If you're using a one variable equation, you're saying home sales will never rise, right? Because the nominal rate, not the total PITI cost, not the selling equity, right? So there's all these different variables that go into the equation. I am not going to reduce the conversation to a one variable because then I can't explain what happened in the last 10 years. Everyone else doesn't want to talk about that, but this has been going on for years because there's a huge discussion here. It's just too nerdy, right? But I am willing to have it with any human being on planet Earth because if
so what you're saying, Logan, is you're too nerdy for the rest of us. That is what you're saying. Okay, you own that.
I'm just saying I question a premise when it's only one variable into an equation that has multiple variables in it. And then it's a really clever market. There's a reason why I hated the mortgage rate lockdown. And I opened myself to the whole possibility of it last year. Okay. So all the things I needed a mortgage rate, but I realized I was wrong. I made the same mistake everyone else made. I made it a one variable topic, and it's not true, because we had massive housing inflation, right? Home prices took off, which means home balances take off, right? But if you have selling equity, it's a different equation. See, all these things come together, and I'm not going to make it a one-trick pony, because we all know what happens with one-trick ponies.
What
They get stuck.
Okay.
They get stuck. They can't do anything else.
Okay, we are out of time for today. Thank you so much for diving in, especially in mortgage rates. This is so important as we're heading into the spring home buying season. So, Logan Mohtashami, thank you for being on this live edition.
Pleasure to be here.